Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron provide a quick primer on common and useful statistical methods: mean, median, mode, standard deviation, bell curves, and so on. With the normal distribution, the mean should equal the median, and the law of large numbers allows you to make inferences between a sufficiently large sample and the overall population. Unfortunately, most things don't behave as normally as we would like, and this is where things can get tricky. Even so, maybe Warren Buffett is just a beneficiary of the Wyatt Earp Effect, which is a great reason why you need to understand the fundamentals of statistics before you put your hard-earned money to work in the financial markets. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week we did our 1 year retrospective, and one of the things that it wasn't top of mind, it wasn't like a big thing, but we realized that we've described various statistics and kind of statistical analysis over the last year. I know we've brought up Wyatt Earp Effect a few times and have to kind of give this super quick primer on just what that is. So today, mostly to entertain ourselves, Trish and I are going to be going a little deeper in just an explanation of some of the statistics that we look at and some really basic examples so that our listeners can kind of understand when we use some terms, how they actually apply. So Trishul, do you want to start us off with just a kind of very high level intro to statistics, the very first course that you'd have in statistics, maybe even all the way back to elementary school or so? So what's our intro to statistics for today before we move on?
Sure. Happy to give a little background and just highlight a few basic things to get the ball rolling. And frankly, I know we use some of these terms here and there, and I also want to highlight that I feel like these terms are quite useful for just navigating life in general, because we just get bombarded with numbers all the time, and just having a way to kind of titrate those numbers into meaning and understanding, I think, is just useful. So something I've said before is I kind of wish that they taught a little more finance in elementary school. I kind of think the same thing as it does come to statistics as well. Just having a good understanding of some of these concepts, I think, is relevant to just being able to navigate life. So I'm glad to have this conversation as well. Now, when we think about statistics, what we're really trying to do at a basic level is we're trying to take a large amount of data and kind of make sense of it. So the very first statistical measure that I kind of think about is just when you see a large set of data, you want to know what's the average value within that data. And that's something that's known as just your arithmetic average, your mean. So from that standpoint, for example, you have 10 people, you can find their average height by taking all their heights, adding them up, and dividing by 10. So that's the first statistical measure that I think of. And then kind of add in more analysis where you might want to know a little bit more information about these 10 people. You may want to know who's the tallest and who's the shortest. So having just those three data points actually gives you a good understanding. Three numbers can give you a pretty good understanding of what this sample of 10 people looks like. So after that, you might want to understand, okay, for these 10 people, where do they stand with respect to the entire population of, for example, let's just say males within the United States? Are these 10 people on average taller or shorter, or are they close to what you would expect for the average male within the United States? So when you start thinking about this level of understanding, now you want to bring in a little bit more horsepower. And this is where, now that we have something known as an arithmetic mean or average, we may want to think about, well, okay, what is the median? And this is slightly different from the term of average. When we think about the median, we're actually thinking about what is the height where 50% of the people are above this value and 50% are below. So it's like the middle case. And we can talk a little bit later about what the difference is between the average and the arithmetic mean versus the median. But just for now, let's just say the median is, 50% are greater and 50% are below this number. So we can take those 10 people and we can find the median case. In this case, since there's 10, we have to take number 4 and number 8 and kind of average that to get the actual median of this set of 10. But if there was 11, you would take that person in the middle. So, yep.
If there's 10, you're taking number 5 and number 6, right?
Sorry. Yeah.
Yeah. You have
taking
10,
number
five people below and numbers 6, 7, 8, 9, 10 above.
That's absolutely right. Yeah. And so now that you have this median number, the third statistical measure that people might hear about is this concept of mode. What's the most common height that you see? Now, if you're rounding to the nearest inch, you might find that 3 people are like 5'8", something like that. So this might be just a good basic set of statistics to have in your back pocket when you're analyzing a large set of data.
Okay, so we have our range, our mean, our median, and mode. Probably, I feel like it does not get used very much, but it is important to at least know what it is.
Yeah, it perhaps doesn't come up too often. What is the most common occurrence within a data set? But it's good to understand that there might be a case here and there where you get to use it.
Yeah, it's probably actually, now I think about when you have any kind of voting structure, or it might help with like a plurality aspect. That actually would be the mode, which result is chosen the most. So
right, yeah, and it's usually more common when you have a distinction between things that you can measure, or sometimes they're continuous, like heights, meaning this person is 5.81269 feet tall, and this next person is 5.9215 feet long. Whereas if you're counting the number of eyes that these people have, the mode is 2. Everybody has 2 eyes in this particular set.
Yeah. Like I think my daughter's in 4th grade, and they're doing the intro of mode is, okay, what kind of party do we want? Do we have an ice cream party, a pizza party, or a donut party? And while you might have the majority of the class doesn't want pizza, they want ice cream or donuts, it's still possible that the pizza gets the most votes. So that's, like you said, those discrete variables as opposed to continuous variables.
Right. With that level of statistics, it can be quite powerful, but there's also the ability to add in, just a little bit more math to be able to discern more insights into a set of data. And the big number the big calculation that tends to come up next is this notion of standard deviation.
Mm-hmm.
So with this notion, now that we have, let's say, this sample of heights, or it can be done with many other types of measures out there. For example, if we're measuring a rolling of a single die, the numbers can be 1, 2, 3, 4, 5, 6, but on average, what should you expect? Well, yep.
I was gonna say, yeah, that's a good example, and we'll probably use it more because you're going to expect the die to have each number will come up the same number of times.
Right. You can expect each number to come up 1/6 of the time.
Mm-hmm.
So a 1 can come up 1/6 of the time. A 6 can come up 1/6 of the time. So your average number that you're probably going to get when you roll the dice, actually, if you just do the math, it ends up being 3.5.
Yeah. So our mean is 3.5. It's also our expected value because we kind of know the probability of the number of rolls and the number of outcomes. So in this case, our mean equals the expected value given enough rolls. But in this example, it's actually impossible for the mode to be 3.5 because it's not one of the things that gets chosen. In fact, the mode could be any one of the 6, just depending on how the rolls go. And we'd actually even expect the mode to even out, and maybe they're all the same.
Right. And, kind of applying another kind of random occurrence is like the daily movement of the S&P 500. Today it might be up 1%. The next day it might be down 1.5%. But in terms of the mean, it's actually up slightly 0.04% or 4 basis points, meaning it's just slightly positive. And that makes sense because on average, the S&P goes up. But you might be wondering, there's so much noise in there. What can I expect on a typical day? Well, to understand what the S&P does on a typical day, you would use this measure of standard deviation, meaning in a standard case, how much would you expect this S&P to deviate from the mean? And this is just a calculation you can do. And based upon this calculation, you would come up with a standard deviation on a daily basis of about 1.2% for the S&P. Now, what that means is, or what that signifies, is that, again, on your average day, you're going to be up 0.04%, but you could be between 0.04% plus 1.2% minus 1.2% about 68% of the time. That's what the standard deviation measure tells us.
Okay, so it is possible, let's say we have 2 stocks and we're going to do an annual return. They both have an annual expected value, an average return of 10%. They both also actually have the same range. They have the same max and same min. They've both had a plus 50% in 1 year and a negative 30 in 1 year. So I've given it a kind of the average 10% plus or minus 40% is the range. But the standard deviation would help measure how likely they are to be closer to that average. So they could have the same range, same average, but the higher standard deviation, let's say it has a standard deviation of 20%, you could expect it to be somewhere between plus 30 and negative 10, 2/3 of the time. But the stock that has a standard deviation of 5%, you would expect it to be between plus 15 and plus 5, 2/3 of the time. So standard deviation adds that kind of how close to the mean is the general grouping, because that's not captured by mean, it's not captured by range, and you need a lot of results to kind of have a good data on the standard deviation, but it's kind of how close to the average are most of the results.
Right. And what we kind of find with the S&P is if you look on that daily basis, you actually do see quite a bit of noise. Again, you're going to be effectively plus minus 1.2% on it 2/3 of the time. And that's the first standard dev. The second standard dev is what you're going to be 98% of the time. 95% of the time. So instead of 68% of the time, you'll be 2 standard devs away about 95% of the time. So that means instead of being plus minus 1.2-ish, you're actually plus minus 2.4%. Now, 1 in 20 actually means about once a month. There's about 21 trading days in a given month. So being down about negative 2.4%, 2.3% in once a month should be about expected. If these statistics are random in nature. We'll talk about what that means to be random, but let's hold that off for just a little bit. But the reason I kind of put that out there is because a lot of people, if they see the market drop 2.3%, they might actually be a little scared about what just happened there, especially because on average, after an entire year's worth of returns, we're only targeting about 6-7% in total. So, losing a third of that 6-7% in a day is something you should expect once a month. Just something to kind of put those numbers into perspective.
And it works on the upside as well. That you're going to get those positive days about the same. Again, kind of assuming the random variable, assuming normal distribution, that the plus 2.3% should happen about as often over a year as the negative 2.3%.
Yeah, roughly. So, in fact, what you could do is if you take all of these daily returns for the S&P and you plot them on something called a histogram, and that basically just buckets the returns into, like -5%, -4%, -3%. It counts all the returns that are negative, 1%, all the returns that are 0, 1, 2, 3, 4, 5. It just counts how many returns fall into these various buckets. And you look at that chart, it looks like this phenomenon known as the bell curve. It looks like a bell, meaning most of the returns are going to be, or specifically, as we had said, 2/3 of those returns will be kind of near that mean of 0.04%. And then 95% will be within 2 standard deviations on each side, plus minus 2.4%. And then just one step above, about 99.7%, the vast majority of those returns, basically all the returns you might expect in a given year, would be plus minus 3 standard deviations.
Yeah, and that's talking about the bell curve is going to be really important, and that normal distribution. In this case, normal specifically means that bell curve where 68% of the time we're within 1 standard deviation of the mean, 95% of the time we're within 2 standard deviations of the mean, and 99% of the time we're within 3 standard deviations of the mean. The simplest example I can think of is if you had 2 dice, and if you kind of look at a chart, kind of intro statistics, you have a blue die and a yellow die. You kind of keep them track. So the blue die can show up 1 through 6. The yellow die can show up 1 through 6. You have 36 possible results. And each of those 36 results are just as likely to occur as each other. Just like we, with that one-sided die, we actually just did 6 squared is kind of how we got there, 6 times 6. But when you add up the sum, 6 of those 36 results will have a sum of 7. 5 of those 36 results will have a sum of 6. 5 of those 36 results will have a sum of 8. And you keep going out until only 1 of those 36 results has a 2. 1 of those 36 results has a 12. And you actually get a really nice bell curve. 7 happens most often. 6 and 8 happen next, then 5 and 9, then 4 and 10, then 3 and 11, then 2 and 12. That happened the rarest, and actually follows that bell curve shape really, really well.
Yeah, and it's an interesting mathematical phenomenon where if you follow the theory, what it says is for any random variable, any variable that's kind of random in nature, and dice are a great example of randomness because ideally they're supposed to be unpredictable. They're supposed to, when you throw them, come up with an independent result every time between 2 and 12 if you have 2 dice. Well, for any type of variable that's random in nature, you should see this pattern of a bell curve when you plot it and you count these occurrences according to some segmentation of buckets. And it's one of these things where it's not really a a phenomenon that was created by humans. It's just the mathematical nature of things. It's just how things work when you add randomness into the equation.
Yeah. So you can actually, again, measure that range, that mean, standard deviation of those. And in this case, it's usually the case that with a random variable, you know what? I want to kind of double check my thought. I'm asking you, Trishul, if you have a random variable, has a bell curve, normal distribution, the mean should equal the median, right?
Yeah, for a normal random variable. That word normal kind of implies that.
Okay. And then also, it kind of, now we're going to kind of explain the law of large numbers. So if you only roll those two dice a couple times, you won't have enough results to look like that bell curve. So it can be very, very different. But if you roll enough times, so a large number of times, then the results of those rolls will start to look like that bell curve. And so if you have a small sample, your mean or median could be different. They could also not look like the expectations of what probabilities to show. But if you roll it enough times, then we start to see the actual average of all those rolls gets closer and closer to our expected value, to what we expect to be that mean and median of the total sample size. So that's another one of like just a few rolls, we can put together data on that. But if we have a larger sample, or how to interpret how likely those results are given the larger sample, that's where the law of large numbers comes from. That you need enough results for the actual results to line up really, really well with the probability expected results and the expected values.
Right. And what that can do is it can actually tell you where there may be biases that are showing up. For example, let's say somebody snuck in a pair of loaded dice into the table. Well, what you could do is you could keep track of the actual outcomes of these two dice. And the more outcomes that you get, you can start drawing this histogram pattern. And if it doesn't start looking like this bell curve, meaning if there is a higher peak not around 7, but if there's a higher peak around 6, well, then you know you're dealing with a loaded dice if you have enough data points, if you collect enough rolls. And the more rolls you collect, the closer you should get to an understanding of, is this pair of dice loaded or not?
I like that. And so when we talk about law of largest numbers, we're usually using it in the context of life expectancies. That's the most common one we've talked about over the last year, where if you know the expected average life expectancy of a population, you can either do it from birth or from a given age. Then you can, if you get enough people in your pool, they'll start to resemble the same statistics as the population average overall. So if you have 10 60-year-olds, you don't know how long they're going to live. There's the sample size is too small. But if you have 1,000 60-year-olds or 10,000 60-year-olds, you can actually get pretty accurate of, okay, approximately half of this pool will pass away before the expected life expectancy of the population of 60-year-olds. And that's how insurance companies are actually able to price in some of the things related to insurance and annuities and pensions. So that's how we usually end up using it. But law of large numbers doesn't have to apply to there. It's actually it's the statistical concept first that's applied to the population rather than vice versa.
Right. And, kind of just tying in that height example I started the conversation with, let's say you have 100 million males in the US and you wanted to figure out that average height. Well, you could go ahead and ask 100 million males what their heights are and do that calculation. But, let's say you don't have all the resources that you would like for your little experiment. Well, you could approximate that average height with just calling, 10,000 people, and you could be pretty confident you're near what that value should be, just based upon using this notion of law of large numbers and statistics. You can approximate that value by only calculating or calling up a small sample of that 100 million total. Now, a few things to keep in mind, though, is that sample should be representative of that population, meaning it should be random in nature. If you go call everybody in your hometown and your hometown has some sort of bias for having taller people, well, then that's just going to throw off the numbers. So you want to make sure that if you're sampling from a population, that you're doing it in a fashion that's random. And that's why a lot of these statistical measures can kind of be off, because the actual sample itself that's used to calculate some sort of value is not really representative of the entire population.
So when I'm trying to get an average height of males in the US, I shouldn't go to the NBA bubble and start measuring all 2,000 people in the NBA bubble. I might get an inappropriate result. Is that what you're saying?
Yeah, your stats teacher wouldn't be too happy with that.
But I measured a lot of people. Like, I measured everyone in the bubble, and does not represent the overall population.
Yeah, and you can imagine how this becomes an issue. For example, if you're a drug company and you're trying to do tests and your sample isn't quite representative, you might even notice, for example, there's a lot of psychology surveys that are done on campuses around the country where students can come in, they can take some sort of test, and a paper can be published based upon these results. But in fact, what we're really finding out really well is how does your average college student from 18 to 22 behave, which may not be anywhere near how the average American behaves. So that's something to keep in mind when you're reading about a study and you see some sort of results. You might want to see, okay, who did they look at for coming up with this understanding?
So law of large numbers is that kind of either given a good random sample or representative sample, if the sample is large enough, we can expect the results of those samples to line up with the overall population. So we can expect the mean, median, range, and standard deviation of that sample as it gets big enough to be representative of the overall population, mean, median, standard deviation, etc.
Right.
So if we measure a really good sample and we know the average height is 5 feet 8 inches with a standard deviation of an inch, I'm making that number up, then we can actually say, okay, we can expect 1/3 of US males to be outside the range. So I'm going to cut that in half. So 1/6 to be greater than 5 feet 9 inches. So I think standard deviation is probably like 2 inches. Not anything bad. So 1/6 of the population is greater than 6 feet. 1/6 of the population is shorter than 5 feet 6 inches. And so then we know the total population of the country. And so we now have 300 million Americans. We have 150 males, probably 120 adult males. So now we can actually calculate approximately how many adult male Americans are over 6 feet based on the statistics of our 1,000 person sample.
Yeah, that's right. And again, one thing we're also assuming in this calculation is that variable height to begin with is random in nature. And for example, there may be a confounding variable that implies that it's not really random. So that we started this with the notion of looking at the heights of males. But if you actually looked at the heights of males and females, you might see a different pattern. You might see, two averages kind of pop up on your bell curve, which might be confusing at first if you were an alien, for example, and you didn't know that, half of these people are biologically different from this other half, half are male, half are female. So that's one thing to consider when you're thinking about a variable to begin with. Is it even random enough in nature, or could there be a variable that's kind of confounding that data? For example, if you're looking at, heights of people and you happen to just select people from America and are Scandinavians taller?
Yeah, I think Scandinavians usually taller.
Okay, and you happen to also pick a lot of Scandinavians. Well, then you might also see a non-bell curve when you're looking at this sample of data and you try to plot it on a histogram. So that would be your first indication that something maybe a little more complex is going on here that you need to think about.
Yeah, that's a great point. Just thinking about, is the thing we're measuring random, or is it a normal distribution, or is it not? And I don't want to get into it today, but when it comes back to stock returns, there's kind of it using statistics based on the assumption of a normal distribution does help a lot, but there's also some pretty good evidence that stocks actually will display a reversion to the mean aspect. And so what we talked about with the dice rolls, where each roll is independent of any other roll, there's no impact. It may not be the case, it's actually likely not the case with stock returns, that if it's down enough, we're more likely to see that it's up the next day or up the next year. Possible on a daily basis, there might be a closer to a normal distribution, but it is important to kind of keep that in mind, that the statistics on stocks are really helpful, but be careful of which ones are based on the assumption of a normal distribution, and is that an appropriate assumption?
Yeah, I agree. So with like the stock market that look really random, the tricky part is there may be some randomness in there, but there may also be some patterns that could lead to the statistics not being as helpful as you would like. And Aaron, you did point out one of those where, for example, there's this seasonality that we see with stocks where if times are good, you might be more likely to see a lot of good days clustered together. And when the season is kind of bad, when you're in like a bear market, for example, you might see returns that are statistically different than when times are good. You might see a lot of bad days clustered with each other. So that this is the notion that each day is not necessarily independent from the following day, just unlike a roll of the dice, where each roll should, in theory, be completely unlinked to the previous roll. It's something, for example, at the roulette table, they show those numbers of what the past, 10, 15, 20 turns of the wheel happen to be, and you can even see some statistics on there. But something to really understand is that very next roll that comes up should have absolutely no relationship to whatever happened the past 15, 20, 30, 100, even a million times. It's something that, perhaps that intro to stats professor has asked. You have 10 heads in a row, what's the chance of getting a head for the next flip of the coin? Well, the answer is still 50-50, because in theory, there is no memory embedded in that coin. That coin doesn't know that it got 10 heads in a row. But the tricky part with the stock market is there's a lot of human factors involved. There's a lot of, as we mentioned, bear market, bull market factors that are involved. And it might be a little harder to come to the conclusion that it's completely random on a day-to-day basis. Now, I just want to point out, though, just because it's random doesn't mean it's so predictable that you can make money off it. So I don't want to make it sound so easy that, you can look for a pattern. Believe me, a lot of people are trying, and it's one of the hardest games you could play.
Okay, so I think that's a great discussion on normal distributions, but I want to move on to non-normal distributions and the kind of understanding how we're applying the same statistics, or the same mathematical formulas, but our results are different, and we need to understand kind of what some of those histograms look like. So, being the nerd that I am, back many years ago, I think it was on the scale of 8 to 10 years ago, a friend sent me an Excel spreadsheet of the 2000 US Census population by county. And I was using this to practice my Excel skills and practice some of my statistical analysis. And so for this spreadsheet, the population in 2000 for the United States was 282 million people. But this was a great example of something that's not a normal distribution. It's not even close. So in the US, again, this is as of 2000, there were 3,143 separate counties. And the largest county was Los Angeles County, with a population a little over 9 million. Second largest county was Cook County, which holds Chicago and Illinois. It was about 5.3 million. And then Harris County in Texas was 3.4. Maricopa County, where Phoenix is in Arizona, was about 3 million. So you had a few of these really, really large counties. And so that's we get our population of 282 million. But the median population for a county, the median, so the very middle result, was only 24,670. And so this was I'm going to go through a few of my interpretations as I've put together this, was a good example of you have a few really, really, really large counties and a lot of really small counties. So this would be kind of trying to average, if you imagine you're taking the average height of adult males, but you happen to pick a room that there's 10 adult males in, and 2 NBA players just happen to be in that room. You can actually imagine like those 2 NBA players are going to throw off our mean so much that now actually the median is a much better interpretation of kind of the middle result. And so of the 282 million people in the US, across a little over 3,000 counties, the average county size was almost 90,000. And so we kind of saw, even though the median was 24, those few large counties really threw off kind of the mean versus the median. To help you understand, the top 50 counties, so this would be only 1.6% of the number of counties, so 50 out of 3,000, held about 30% of the US population. And the top 5% of number of counties, so it's 157 counties, held over half of the US population. So that's a good example of 5% of the counties hold half the population. And as you kind of look at these further and further, you see similar results with things like incomes, net worth. That's another example where you have these very skewed distributions that are not normal distributions at all. And so that's why when we looked at this population by county, the mean was 90,000. The standard deviation was actually 293,000. So half of the kind of number of counties were within one standard deviation, but those top counties were multiple standard deviations out. It was, they're kind of so far out in terms of the size that there are tens plus standard deviations out. So you have half of the population was within one standard deviation. So it's probably even more. It's even more than that. But you also have the majority of the population that lives in counties that are 10 plus standard deviations out. So that's why a mean and standard deviation don't really help understanding what does the population look like when break down in terms of counties. And again, almost same thought process works with things like income and net worth, where the few really high income earners or really wealthy people throw off things like mean and standard deviation, but the median is actually a helpful interpretation of the overall population. So Trishul, when I kind of describe that, one, do you have any kind of questions for me? I have this in front of me. I might be able to answer them quick enough, but anything that you like to add in terms of how you interpret non-normal distributions?
Well, I think you brought up an awesome point when it comes to, for example, looking at statistics around median and mean household income and wealth. It's really interesting because you can have a increasing mean or average, that is, and everybody thinks that things are getting better, but it could be just those billionaires are turning into trillionaires. Whereas if you look at the median household income, that might actually be staying the same or going down. So yeah, on the surface, the mean looks like things are getting better for the US population. But if you look at the median, if average household incomes are actually going down from that perspective, what's really happening is, maybe 10 people are getting super uber rich and the rest are just staying about the same or being worse off. So I think when we're looking at policy, it's very important to understand this distinction. It definitely can create a big difference when you break it down from this perspective. So to kind of just add some numbers behind that, this isn't completely apples to apples, but the average income in the US is around $97,000 for a household. But if you look at the median, it's only $68,000. So what that means is the significance of that is you have basically a lot of people skewing that a small number of people skewing that average number up by a good amount. But if you basically sample a good amount of people, it's going to be closer to that 68,000 number. That's going to be more representative of what you're going to see, because that small handful that's pulling that average number up only applies to a very small percent of the population.
So do you remember just the technical definition of how to describe skew? I know I don't remember the actual way to define it, but is idea of when the mean is different than the median, especially, then we're seeing more on one end. That's where we get skew, where the farther the median is from the mean, or the mean is from the median, we get kind of greater skew. I just don't remember kind of how else to describe it or think about it.
Yeah, the skew is basically the understanding of that differential between the median and the mean. And it's a statistical formula that incorporates, some understanding of standard deviation and how big your sample is. But at a high level, that's spot on there.
Okay. Anything else that you think of in terms of non-normal distributions, either times you see that we should be aware of, or how else to think about it?
Well, the other measure that kind of comes up when you think about non-normal is, we talked about skew, meaning there could be a differential between the mean and the median. And then the second one sounds like a $10 word. It's known as kurtosis. But what we're really trying to say with this other measure is, when you look at the far ends of the distribution, there may be more or less data points than you suggest, or than is suggested by a standard bell curve. For example, if you look at stock returns, you actually notice this concept of a fatter tail. You're noticing more events that are far more negative and far more positive than you would have with a normal distribution. So with a normal distribution, the farther you get away from your average case, the less likely you should see an occurrence. For example, you should see a negative 5% day less often than you see a negative 4% day. You should see a negative 6% day less often than you see a negative 5% day, and so on. But what we've kind of noticed when we look at the distribution of stock returns, like the S&P 500, we're noticing more events in the negative area than you would see otherwise. And this kind of implies that, or it's another way of saying that, yeah, the S&P or the market doesn't quite follow a normal distribution. They tend to have fatter tails. They tend to have more of these outlier events than you would expect. And the reason for that is also kind of behavioral. What we kind of see is this kind of pylon effect of fear, for example. When things get bad, a lot of bad days tend to follow because people kind of run for the exit. And something like that can lead to more of these types of events that you would see otherwise if in the case where people acted a little more rationally.
Okay, so if I want to try to understand kurtosis and make sure I get this correct, let's say we did have a normal distribution on stock returns on daily stock returns, and so we know our mean equals our median. We have a bell curve, so just as likely to see +1 standard deviation or -1 standard deviation. We could even have a second chart that has the same standard deviation. So kind of that middle 68% and that middle 95%. But if the kurtosis is different, maybe the probabilities of standard deviation don't apply at those tails. So what we think is 99% of our results are going to be within this range, kind of ±2 standard deviations. It's actually only 90% of the results, where the events that we think should happen only 1% of the time, it's like on a 0.5% on the high end, 0.5% on the low end, are actually occurring 10% of the time. Could that be the same from what you understand of if we have the same mean, median, and same standard deviation? If they have a different kurtosis, could we see those different curves?
So this would be a case where even if there's no skew in the data, you still might see the case where you're seeing more events than you would expect if you go further out.
Okay. So mean, median, normal distribution, non-normal, skew, kurtosis. This did feel a lot like a intro to stats class.
A little bit, yeah. And hopefully this will just kind of lay a bit of the foundation for some of these words and terminologies so that perhaps, in just later episodes, we might just go a little bit deeper on some of these concepts as they apply to some of the things we're talking about, because it can just provide more insight to be able to get a little more granular with things, because there are situations where just having this basic understanding lets us uncover insights that you may not otherwise be able to see at a higher level.
Just one thing is I realized we didn't actually go into the Wyatt Earp effect. This is the kind of related to the law of large numbers, and it's named after Wyatt Earp because he survived a lot of gunfights. But it's if you have enough people or a large enough sample or large enough population, then we start to see, we can actually expect to see those tail events. That even though the odds of winning 10 gunfights in a row are rare, or the odds of flipping a coin 10 times in a row and getting heads every time, while that in of itself is pretty rare. So if you did like the 2 to the 10th kind of thing, you're going to say, oh, this will happen. There's only a 1 in 1,024 chance of this happening. So it's a 0.1% chance of happening. But if you actually do 1,000 or 5,000 or 10,000 flips, you can start to actually expect to see those 10 heads in a row. And you actually expect to see kind of streaks like that. You can also maybe think of it as a tournament model. If it's March Madness and there's 64 teams in the NCAA tournament, and you need to win 6 games to win the national championship, even if every game was an even 50-50, and so any individual team has a 1 in 64 chance of winning, okay? So each team only has a 1.5% chance of winning the tournament. Some team actually has to win each game and play out, and they won 6 games in a row and they win the national championship. Because you started with 64 teams and you've designed the structure that, yes, the odds of any individual team winning that national championship are very low. Because you have a large enough sample, it's expected that some team will go on streaks like that. And that's the idea of the Wyatt Earp effect, that Wyatt Earp, he might have been a great gunfighter. He could also just be the one who randomly survived the number of gunfights in a row that we would expect to see given a large enough number of gunfights.
Yeah, that's an awesome point, Aaron. It ties into this thought process where with the stock market, you always hear about people beating the market. But it might actually be that somebody statistically just needs to be able to beat the market because you have literally billions of people investing. Somebody has to be able to have a track record that looks so awesome that it just kind of beats it year after year after year. Even though it's very statistically unlikely, those people have to exist. And, something we mentioned is, for example, yes, we have cases like Warren Buffett out there and a handful of others who have done so. But statistically, these people, again, just have to exist by pure randomness alone. In fact, there probably should be more Warren Buffetts than we actually see.
Based on how many people are trying to invest like this.
Right.
Yeah. Okay. So is that our headline? Is Warren Buffett a genius that we should quote often, or just the result of randomness?
Well, Aaron, you have our title.
That's your job, though. I'll let you refine it.
It can be the working title.
Okay, there we go. Well, thanks very much for the conversation today, Trishul. I know it's got kind of wonky, and I don't know how much our listeners like it, but I really enjoyed it. So thank you.
Well, as long as we're looking out for number 1 and 2, I think we're okay.
Sounds good. I
Right,
believe that's my alarm
Aaron.
to get out of here.
Right on. All right. Thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.